Welcome to The Brief, where we analyze the latest news impacting residential real estate investors. Today we are diving deep into the latest economic data that's sending shockwaves through the financial system. We are going to unpack the hot consumer price index print, analyze the ripple effects through the mortgage market, and explore what the historical context of inflation regimes can teach us today. Most importantly, we are also going to break down exactly what this means for residential real estate investors trying to navigate a tricky market. Before we jump into the numbers, a quick word about property alpha. In a market where borrowing costs are eating into margins, finding cash flowing properties is more challenging than ever. PropertyAlpha.ai has cutting-edge tools to help residential real estate investors find high-quality deals faster. If you want to stay ahead of the competition and pinpoint the best investment opportunities in real time, Property Alpha is where you ditch the spreadsheets and find your edge. Alright, let's get into the headline news. The latest CPI print for April showed a 0.6% increase on a seasonally adjusted basis. Now you have to pair that with a massive 0.9% increase that we saw in March. Together this makes for two of the hottest months of CPI prints we have seen since 2021. On an annual basis, the all-items CPI rose 3.8% over the last 12 months, which is the fastest annual pace we've seen since 2023. So what's driving this surge? A huge part of the story is energy and specifically gasoline. In March, gasoline prices skyrocketed 21.2%, accounting for nearly 3/4 of the entire monthly CPI increase. That pain at the pump didn't stop there, as gasoline prices increased another 5.4% in April. We are also seeing alarming trends in the technology sector, with prices for computer software and semiconductors rising sharply. Software alone's up 14% year over year after decades of low inflation and even deflation. But to understand how this hot inflation impacts the housing market, we need to define a key concept: the mortgage spread. Simply put, the mortgage spread is the difference between the 30-year fixed mortgage rate and the 10-year US Treasury rate. Normally, these two rates track each other closely. But why is there a spread in the first place? It comes down to a unique risk that mortgage investors face called prepayment risk. Here is how it works. Unlike most corporate or government bonds, US mortgage borrowers have the option to prepay their loan balance at any time without a penalty. Typically, they do this by refinancing when interest rates drop. For the institutional investors who bought a bundle of 30-year mortgages, known as mortgage-backed security, or MBS, this is a massive problem. When rates fall, homeowners refinance. Suddenly, fixed income investors get all their cash handed back to them at the exact moment when their reinvestment options are offering much lower yields. To compensate for them bearing this risk, which is essentially being short the borrower's prepayment options, MBS investors demand a higher yield. Now let's tie this back to our hot CPI prints. When inflation runs hot, the Federal Reserve usually steps in to cool the economy by delaying rate cuts or keeping short-term interest rates high. Because of this, reinflation and roughly stable labor markets, fears are growing that the Fed might actually hike rates again instead of the anticipated and hoped-for cuts. To fully appreciate this, let's look at the historical relationship between inflation regimes and these spreads. Historically, the volatility of long-term yields and spreads depends heavily on how well inflation expectations are anchored. Since 1980, there have been several episodes where 10-year Treasury yields spiked by more than 100 basis points in just 6 months. However, the vast majority of these extreme episodes occurred back when long-run inflation expectations were simply not as well anchored as they are today. When inflation expectations are shaky or the Federal Reserve's policy path is unclear, market uncertainty causes spreads and term premiums to widen. Look at 1994. The Fed began tightening their policy, but communications weren't as explicit as they are today, and the resulting uncertainty caused the 10-year Treasury yield to shoot up 200 basis points in 9 months. We saw a similar dynamic in 2003, where confusion about the Fed's reaction function led to a sharp increase in uncertainty and a higher term premium. Today, with inflation not only proving stubborn but also accelerating, and the potential of the Fed abandoning its planned rate cuts, that same kind of uncertainty is creeping back into the market. So what does this all mean for residential real estate investors? First, it means the cost of your capital is facing unprecedented upward pressure. You aren't just dealing with a high 10-year Treasury yield, you're dealing with a blown-out mortgage spread driven by the low demand for mortgages. This makes financing acquisitions or refinancing existing properties incredibly expensive, significantly compressing your cash flow and making standard deals tough to justify. It's hard to find the profitable deal in the proverbial haystack. On the other hand, the second takeaway is that there is a powerful silver lining in the inflation data. Because these blown-out mortgage spreads are pushing borrowing costs to levels that everyday home buyers just prices them out of the market, those potential buyers are forced to remain in the renter pool. This sustains incredibly high demand for rental units. We see this directly in the April CPI report. The shelter index increased 0.6% over the month, and the index for rent of primary residence rose 0.5%. Over the last 12 months, the shelter index has climbed 3.3%. For investors, this means top-line revenue, your rental income, remains incredibly resilient. The fundamental problem isn't tenant demand. The problem is finding properties that can clear the hurdle of today's inflated borrowing costs. Because the math on deals is tighter than ever, you can't afford to waste time analyzing properties that don't pencil out. You need precision and you need speed. This is why Property Alpha is so vital in the current economic climate. We have built the exact tools residential real estate investors need to find high-quality, cash-flowing deals faster than the competition. By leveraging our technology, you can cut through the noise of a high-interest rate environment and pinpoint the properties where the rental income outweighs the blown-out mortgage spreads. It's a complex economic web, but understanding the mechanics behind prepayment risk, the yield curve, and sticky rent inflation gives you the clarity you need to adapt your investment strategy. Thanks for tuning in. If you have questions or perhaps a different take, comment below. We will keep tracking these numbers as they develop, and I will see you in the next episode. Don't forget to like and subscribe for more alpha.